mentioned, my name is Mesam. I'm a lead analyst with Moody's based in Singapore, and I cover a number of Indonesian coal miners that we rate. I appreciate most of you on this call are more knowledgeable than me on the Indonesian coal mining sector. So my intention is not to teach you things about the sector you may already know, but I thought what might be interesting today is if I can share how we as a rating agency view the Indonesian coal industry from a credit perspective and what we think are some of the challenges facing the industry. So if we move to slide 3 in terms of the agenda, I'll start with a bit of background just to provide an overview in terms of our rated coverage for the whole sector across Asia Pacific. And then I want to talk to you guys about 5 key credit themes impacting the Indonesian coal mining sector. And finally, if time permits, which hopefully it does, we can talk through some Q&A. So if we move to slide 5, for some of us who might not be as familiar with Moody's, we are a global rating agency, have over 1,000 analysts based in 25 locations across the world, monitoring some 70 trillion of debt across financial institutions, governments, corporates, and structured finance instruments. And in terms of our rating coverage, just specifically to the Asia Pacific mining sector, if we turn to the next slide, we rate some 24 companies across 5 countries, which together account for close to 50 billion US dollars in rated debt. Of these, 9 companies are rated investment grade, with the remaining 15 rated speculative grade or high yield. And given how the coronavirus pandemic have resulted in a severe contraction in global economic activity, 8 out of those 24 companies have their ratings on a negative outlook, which is actually the highest level of negative outlooks for the sector we've seen in the last 4 years. So then, which companies do we actually rate? If we turn to the next slide, our coverage includes large multinational mining companies such as BHP, as well as large state-owned mining companies in China, such as China Minmetals and Yangquang Group, which of course is the parent of Yanzhou Coal. Interestingly, the greatest proportion of rated mining companies or mining and mining services companies in Asia that we rate are from Indonesia. So Indonesia represents 1/3 of our rated companies, and we've shown that in blue on the chart here. So our coverage includes state-owned mining company Inalum, which of course owns Bukit Asam, as well as some of the largest coal miners in Indonesia, including Adaro, Indika, Bayan, and Bumi Resources. And all of these rated companies represent a majority of the coal produced in Indonesia. So we're fortunate that way that by rating these 8 companies, we can get a relatively good insight into the broader Indonesian coal sector. So what we want to do then in the next section, if we go to slide 8, is just share with you what we believe are the key credit trends impacting the Indonesian coal mining sector, potentially over the next few years. And if we turn to the next slide, the 5 themes that we've highlighted, let's start from the left with earnings volatility. This is sort of a perennial theme where we believe, because coal is so volatile, you will always see earnings volatility. We believe earnings will weaken this year amid low coal prices, but with some modest recovery in 2021. But of course, this recovery is underpinned by the expectation of some gradual improvement in the macroeconomic environment next year. Next, there's regulatory uncertainty. So on the domestic front, these are primarily around license renewals, but also to some extent around production levels and logistics. And then on the foreign regulation front, it's really the uncertainty around any restrictions limiting coal imports. And so I think Jimmy's next section on the China market will actually be quite interesting. Next, we have liquidity and refinancing risk. So for companies in a volatile commodity sector such as coal, liquidity can really make or break a company. So in terms of the Indonesian coal miners we rate, liquidity should be sufficient for most miners over the next 12 months, but that refinancing risk will rise closer to 2022. And we've got a slide later on that explains that. Refinancing risk somewhat ties into ESG considerations, which is a topic that is increasingly talked about. particularly when you speak to your banks, because access to funding is becoming more challenging for companies operating within the fossil fuels industry. And finally, we're seeing an interesting trend, which we expect to continue, which is some miners taking steps to diversify earnings away from thermal coal sales. And we'll share some examples around that in subsequent slides. So let's start with coal prices. And apologies if it seems like I'm rushing through. I'm just trying to make sure we've got enough time for Q&A. But so on this slide, we've all seen the benchmark Newcastle thermal coal price declining considerably this year following the coronavirus outbreak, as slowing economic growth reduced electricity demand, which of course then translated into lower demand for thermal coal. And as a result, we saw Newcastle prices fall below $50 for the first time since the last major commodity downturn back in 2015, 2016. We don't expect such depressed prices to persist for a prolonged period, as we expect production cuts, including from unprofitable mines. And the Indonesian Coal Mining Association has talked about the necessity for this as well. But we do accept production cuts should help improve the supply-demand imbalance as we move into next year. Accordingly, when we do our financial projections for our rated coal miners, we're assuming a medium-term price assumption of Newcastle thermal coal at $65 a ton, which of course is higher than spot prices today. That being said, we don't expect prices to also increase materially as they did after the last downturn. So we don't expect Newcastle to touch $100 a ton, unfortunately, anytime soon. So then what does this mean for the coal mining companies that we rate? So if we move to the next slide, given the weak coal price environment, we expect a considerable earnings decline this year, with many companies that we rate recording anywhere between a 20 to 40% decline in earnings before interest, tax, depreciation, and amortization, or EBITDA. And while we do expect a modest recovery next year, the earnings level in 2021 will still be lower than the earnings generated in 2019. And it's primarily because of these weak earnings that a number of companies that we rate are currently on a negative outlook. And if we move to the next slide, the chart on slide 12, I believe, shows how financial leverage for these companies, as measured by adjusted debt to EBITDA, and that's denoted by the bar charts here, how are they tracking relative to the triggers that we have set for their respective ratings? And that's the red diamond on this page. And what we can see here is that a number of these companies will breach their rating downgrade triggers this year, which is why we have them placed on a negative outlook. And if earnings improvement that we are expecting next year does not materialize, so if earnings are weaker, or if miners need to raise more debt, then this could result in a ratings downgrade for some of these companies. So with that, moving to the next slide, the next theme we wanted to talk to you about is regulatory developments, and in particular, uncertainty over some items which could affect the credit profiles of these mining companies materially. First and foremost is the renewal of the CCOW licenses, which affects some of the largest miners in the country, including Bumi Resources, Indica, and Adaro. Now, the recent implementation of the new mining law provides greater clarity that these licenses should be converted to the IUPK licenses. However, I think the timing and the final terms of these contracts have yet to be decided. While we expect, our base case assumption is that these licenses should be extended at broadly similar terms to the existing CCOWs. I know some of the finer terms still need to be finalized. But one of the first large-scale CCOWs to expire is Bumi's Arutman mine, which actually expires next month. And we believe that will likely set a precedent for other CCOW expiries going forward. There are other regulations which could impact the sector. These include the DMO obligations as well as the price cap on domestic coal sales. We saw how back in early 2018, when the price cap was implemented, there was a lot of lost earnings for miners in terms of domestic sales over an 18-month period when coal prices were still quite high. And there is still some uncertainty as to whether the cap will remain in place, or if the cap could potentially even be lowered given the low prevailing prices. One very important point to note, though, is that while we have talked about some of these regulations in terms of challenges for coal miners, that this is still a sector that remains a very important source of local employment, government revenue, and coal exports, of course, help Indonesia's current account position as well. Therefore, at the end of the day, we don't expect the government to implement any regulation that materially weakens the financial position of these coal miners. And if anything, Pak Irwandi did a great job this morning explaining some of the ministry's initiatives to potentially help support the sector as well. The next theme we have is liquidity risk. So what we've tried to do on the next page of this presentation is we've got a chart here that actually shows the rated debt maturities for all our rated coal miners. And what you can see on this chart is that there's actually no large rated debt maturities over the next 15 months through December 2021. And this is a good thing because it minimizes near-term refinancing risk for most companies. But there is a large $2 billion debt maturity wall for the sector in 2022. And in the event of a prolonged commodity downturn, so if thermal coal prices remain at low levels, credit quality for some of these miners will weaken materially, and this will make refinancing risk more challenging for them. And if we move to the next slide, these refinancing challenges tie into our next theme around ESG, where funding options for coal companies could decline because investors and banks are under growing pressure to decarbonize their portfolio, given the environmental risks. Still, we expect miners which have diversified funding sources to have better access to capital to supplement their liquidity and maintain their credit profiles. And funding diversity for us includes borrowing relationships with a variety of different lending banks and also a track record of raising money from US dollar bond markets. I mean, just last week, Indica raised $450 million bond, which was, I think, the first Indonesian high yield bond to issue since January, first rated Indonesian high yield bond since January. So again, that's something we continue to monitor. And if we look at the longer term ESG considerations, if we move to the next slide, unlike the US or parts of Europe, where coal is already in a secular decline, in Asia, coal will remain a major power source for the next few years. And this is because of the significant existing capacity and the continuing growth in power demand in the region. According to the International Energy Agency's stated policy scenario, which is based on countries' announced and planned emission reduction targets, coal-based power generation will still remain high, although the share in Asia's total power mix will decline as the share of renewables increases over time. Just one point to note here, though, the data here we've presented is on the IEA's 2019 World Energy Outlook. They just published an update, I believe, last week or 2 weeks ago. So there might be some slight updates to the data in these charts. But nevertheless, if we look at the IEA's sustainable development scenario, which we've got as the chart on the right, and that's one of its other energy outlook scenarios, here we can see an absolute and a material decline in coal-based power for the region. So this scenario describes how the energy sector can achieve the objectives of the United Nations Sustainability Development Goals. So certainly the longer-term downside risks for coal demand, even in Asia, do exist. And while we don't expect, while this might not happen in the next 3 years, it's certainly a development that we all need to monitor very closely. So moving to the next slide. Potentially keeping an eye out for these risks, we have seen and expect to continue to see coal miners looking for ways to increase their business diversity to reduce their proportion of thermal coal sales, which is still very high. We've seen some examples within the Indonesian coal miners that we rate. So for example, Indica has publicly announced a plan to generate 50% of its revenue from non-coal business by 2025. And it's made investments in fuel storage as well as a gold project in Sulawesi. Golden Energy, which ultimately owns the Borneo Indobara mine in South Kalimantan, has also sought to diversify outside of Indonesia, including investments in gold and met coal in Australia. And speaking of met coal, Adaro has also made sizable investments in a met coal project in Australia in recent years. It has investments in power projects as well. and it has said that it's looking to invest in renewable energy projects in Southeast Asia. Another interesting trend that we will potentially see develop, and I think Ibu Arfidia this morning had a really interesting session talking about this, which was quite informative for me, which is around the downstream processing for coal. So, the job creation law recently announced allows for potentially 0% royalty for miners that develop downstream coal processing. So we believe, depending on coal prices, of course, and further regulatory clarity potentially, we will likely see miners invest in downstream businesses. And this could result in an increase in capital spending for these miners over the coming years. So moving to our final slide, on slide 18, we just wanted to summarize what we think are the most important things to take away from our discussion on the sector today. And again, many apologies if I went through this very, very quickly. Firstly, miners' earnings will decline a lot this year, and the recovery next year will be modest. Also, the new mining law is certainly a positive, but there are still some regulatory unknowns. Next, we talked about funding and how miners currently have sufficient liquidity, but refinancing risk will rise closer to 2022. Maybe not a near-term risk, but carbon transition risk will strain credit quality for miners over a much longer term. And this is what might be driving the trend where miners are seeking to diversify some of their earnings away from thermal coal. So maybe I'll pause and hand it over to Pak Hendra in case there's time remaining for a few questions. Otherwise, if we go to slide 20, I've got the contact information for myself as well as some of the other Moody's analysts who cover the mining sector in our presentation. So of course, if you have any questions or would like to discuss further, please feel free to reach out or call me. And with that, back to you, Pak Hendra.